Good morning, and thank you for joining today's webinar, which will focus on new dynamics in the aviation sector as a result of rising fuel costs. New research, including a report on the Middle East conflict and potential aircraft ABS implications, can be accessed through the QR code on your screen or by visiting kbra.com. Here, you'll also find information on our upcoming events and webinars. If you would like to connect with our experts to discuss today's topic in more detail, our business development and investor relations teams would be happy to arrange a follow-up call. Now, I'd like to hand things over to KBRA's Chief Market Strategist, Van Hesser, for introductions.
Thank you, Michelle. Good day, everybody. Thank you for taking time out of what is clearly a busy time for what we think is a pretty timely webinar on aviation. I'm Van Hesser, Chief Market Strategist for KBRA. I'll be your moderator today. I'm joined by three experts covering the various aviation asset classes for KBRA. Alan Greenblatt will cover aviation ABS. Boris Alashayev will cover airlines for us, and Michael Dodge will cover aircraft leasing companies for us. Each has prepared remarks. We'll go through those. We'll then open it up to Q&A, where we've had a number of questions come in with registrations. We'll get to as many of those as we can. Let's get started. Let me kick off things with a bit of context. Allison? So just for context, right, we are in the longest economic expansion in post-war history. So don't lose sight of that. If we take out the 2 months of COVID, we are now, I think we flipped over to 202 months of economic growth, where we've averaged really an above average 2.2% GDP growth in the US over that time frame, almost 17 years. So again, a fairly constructive backdrop, to say the least, coming into the events in the Middle East. Next slide. And one more. Yeah, just if we go back to in the first quarter, Q4 earnings call out of Ed Bastian, CEO of Delta. The year is off to a strong start. Top line growth is accelerating on consumer and corporate demand. Consumers continue to prioritize experiences with travel among the top spending categories. Business travel is showing signs of improvement as corporate confidence grows. So clearly we came into the year fairly upbeat on prospects in the aviation sector. Next slide. Then this happened, right? So post the US and Israel war now with Iran, the jet fuel crisis is turning into a disaster for airlines. That comes out of the Wall Street Journal a couple of days ago. So clearly the environment has turned. Next slide. One thing I wanted to point out, and something that we've talked a lot about here at KBRA, is when we talk about a pain threshold for the price of oil, right? We talk about $100. It seems to be the benchmark that the press and market observers sort of have latched onto. If we go back to when this was popular back in 2011, and we adjust for inflation and adjust for increased energy efficiency in the US, the equivalent today is more like $191 a barrel, right? So I think about it in terms of at $100 a barrel, the impact on inflation, unemployment, economic growth is fairly immaterial, right? Things do change, I think, when you get up to north of $150 a barrel, especially if that spike happens relatively quickly. And most importantly, the duration extends out to 4, 5, 6 months or more. That's when you start to really get some impact on economic activity, not only in the US, obviously, but globally. So something to keep in mind as we go through today's comments. Now, clearly, the impact on vulnerable sectors, really energy-dependent sectors like aviation, is an important consideration here. So this is more context, I think, for the growth outlook, but we're going to get into greater detail from our three experts across what this fuel spike actually means in terms of how they view cash flows and the sustainability of those cash flows in their various asset classes. Next slide. So no great surprise, the airline sector within the S&P was actually performing reasonably well heading into the events in the Middle East at the end of February. And since then, no great surprise, the S&P continues to march higher at all-time highs. Airlines, of course, have sold off. Not hasn't fallen off a cliff, but clearly the uncertainty surrounding now the sector is weighing on the price in risk markets, both stock and credit. Next slide. And so this, I thought, came out of Mike Wirth at the Milken Conference, CEO of Chevron, this week, which caught my attention. The buffers in the system are being drawn down, right? That creates more upside price pressure on price of oil, potentially more volatility and more risk, right? So we're getting to that inflection point. Most folks, I think, believe that's going to be sort of towards the end of May or June, when a lot of that strategic stockpile, whether it's by sovereign governments or by corporations, as well as all of that oil at sea and in the process of being refined, are drawn down. That's when I think you've got the risk of a more non-linear or parabolic move up in the price of oil. So again, with context being that, we really start to feel that market $150 a barrel or more, I think that's an important consideration as we think about the near term here. All right, so next slide. All right, so to kick us off, Boris is going to take us through the airline story. Boris?
Thank you, Van, and thanks everyone for joining. My name is Boris Alashayev, and I'll take the airline portion. So the next slide, please. The airline story right now is pretty simple. Fuel moved very quickly, and the airlines have to respond to that almost immediately. But the important point is that the industry is not entering this period from a position of broader weakness. A lot of carriers, especially the larger network operators, have spent the past couple of years repairing balance sheet and rebuilding liquidity. So yes, this is a meaningful shock, but it's hitting the sector that is generally in better shape than it was in previous downturns. So the other point I would like to make is that this is not a uniform airline story. Network carriers, low-cost carriers, and the regional operators are all going to feel this differently. So when we talk about resilience, we really mean resilience with a lot of differentiation underneath it. So on this slide, the main point is the speed of the move. If you could go back to the previous slide, Allison, thank you. Coming into this year, the fuel backdrop looked much more manageable. IATA's December outlook had jet fuel at around $88 per barrel or so for 2026, with the latest monitor showing the jet fuel of around $185 a barrel. So this is a very different planning environment, and it happened rather quickly. This matters because fuel is still one of the largest cost inputs for the airlines, ranging between 25 to 35% depending on the carrier and the period. So the issue is not just the fuel is high, the issue is that the cost reset is immediate, and the revenue response typically takes time. Another point worth making is that the airlines are not buying crude oil directly, they are buying refined jet fuel. So when the crack spread widens, the pressure can be worse than the move in the crude alone. As a result, we're already seeing this kind of reflected in the margins. So we've seen some of the company numbers being adjusted for the full year estimates for various airlines. The fuel bill is already 15 to 20% higher. With some examples, if we look to Delta, for instance, our expectations for the fuel bill to be about $11 billion this year, and for United is roughly $13 billion, just to name a few. So as you can imagine, this is quickly becoming more than just an earnings story or a cash flow story. And unfortunately for many weaker credits, this is really becoming a credit story. At the same time, our view is not really of an industry that is in a fragile state. Airlines have lived through this before. The most recent period during 2011 and 2012, when the fuel cost sustained well above $100 a barrel, airline bankruptcies were more or less manageable. We observed 6 globally back in 2011, and another 18 during 2012. And more recently, last year, we've tracked roughly 12 airline bankruptcies. That's including Spirit and another 3 so far this year. So the point is not that the airlines cannot manage the shock. Many, in fact, can. The point is the stress finds and kind of separates the stronger carriers from the weaker ones. And this is really where this cycle looks a little bit different. Many carriers came into this period with much better liquidity and greater financial flexibility than they had during the previous downturns. So from the credit perspective, balance sheet flexibility is critical. We're monitoring airlines' unencumbered assets that can potentially provide contingent liquidity if conditions stay difficult through the rest of the year. So when we talk about resilience and performance, we're not just talking about margins that are being pressured. We're also talking about balance sheet capacity to absorb that pressure. Next slide, please. On this slide, I've tried to quantify the airline response playbook. So fuel moves first, margins get squeezed, and then management teams start responding through pricing, capacity, fleet deployment, and liquidity management. We've already seen some of those responses in action. So United has cut their overall capacity by about 5% so far. Delta pulled back 3.5 to 4%. And then just more broadly at a global level, capacity is down 3% since March. And that's exactly what you would expect. Airlines cutting back on some of their weaker flying first. From the credit perspective, this is where the differences become more pronounced between carriers. Network carriers have more tools to defend revenues. They typically have stronger hubs, larger corporate exposures, larger loyalty ecosystems. So if the fuel stays elevated, our expectation is that they have more ways to recover at least portion of that additional cost. On the low cost side, we're definitely a little bit more cautious. Some examples, for instance, Southwest is really in its own category, but Spirit shutdown is just another reminder of how quickly stress can build for some of the weaker models. The issue is not just the higher fuel, it's higher fuel hitting the airlines that already have weaker balance sheet position, weaker pricing power. At that point, the conversion can really become pretty stressful, and we can move pretty quickly from margin compression all the way down to liquidity pressure. When we think about JetBlue, it's a really different case, but it really reinforces the broader point that the low-cost part of the market doesn't have a uniform credit story. Some carriers simply have more flexibility than others. And unfortunately for some of the weaker ones across the LLC space, higher fuel can be just that much harder to pass through without hurting demand. The other thing I wanted to mention on this slide is the hedging programs. So for many large US airlines, they have kind of remained lightly hedged. Some of the European carriers have sizable hedge books, but they are not really practical and tend to be temporary in nature. They don't provide a complete shield for the rising fuel costs. So from the airline perspective, our overall credit framing is balanced. The sector is definitely in defensive mode, but it's not uniformly weak. Network carriers generally have more pricing power and just greater balance sheet flexibility, while some of the weaker low-cost carriers have substantially less room to make any errors. And with that, I'll turn it over to Mike Deitch to cover the aircraft lessors.
Thanks, Boris. So looking at lessors, we just go to the first slide. Thanks. So just a snapshot of our current aircraft lessor ratings and our stable sector outlook. So currently we maintain issuer and senior unsecured debt ratings for Avalon of A- for leading lessors, Avalon, DAE, and Sumisho Air Lease Corp, which is part of the SMBC Aviation platform. We also maintain an unpublished BB+ rating for another aircraft lessor. we've had a lot of experience at KBRA rating lessors over the last decade plus, rating 10 plus aircraft lessors. And there's been some significant industry consolidation since we started. We've also rated a lot of lessor-backed secured debt transactions. Just to touch on recent rating actions of note, in March, we upgraded Avalon and DAE on issuer-specific improvements. This included improved scale, profitability, and funding diversity. And we also, in April, affirmed ratings for Sumisho Air Lease Corp. On its acquisition of Air Lease, which was a very notable transaction. So we currently maintain an overall stable outlook, despite the industry challenges for lessors. So this is really underpinned by a few things. Firstly, lessors have highly diversified portfolios, so they're more insulated to specific incidences of lessee default. They have strong available liquidity. They have moderate leverage levels in the 2 to 3 times range, debt to equity. And they have proven access to funding, which they demonstrated even during the pandemic. And just anecdotally, funding has remained widely available for lessors even since the conflict started, with several tapping unsecured markets at attractive rates. Another key factor supporting our stable outlook is structural undersupply of aircraft in the market, which is expected to continue into at least the 2030s. As well as the historically resilient travel demand, even in past downturns. So combined, importantly on the undersupply side, and then the resilient demand is expected to support lease rates and aircraft values over time to the benefit of lessors, even if there's some airline credit issues caused by this crisis. And if we go to the next slide. So thinking a bit more about the conflict and potential impacts and mitigants for lessors. So far, lessors have not reported any material impact to lessee payments or aircraft demand, with lease rates remaining strong. So while airline margins, as Boris was discussing, could be squeezed, airlines fleet planning, importantly, is done with a long-term view. So carriers continue, even though they're proactively planning, sort of maybe adjusting capacity in the near term to mitigate the shock, they continue to look to secure aircraft on long-term leases in an supplied environment. And in particular, the most in-demand aircraft types, which I'll touch on, sort of new technology aircraft, would tend to be the focus of lessor fleets. All that said, prolonged elevated fuel cost environment could, as Boris was mentioning, have different impacts on different airlines, and we could see an increase in delinquencies and defaults, and smaller lessors, which may be more concentrated or might have more, less funding flexibility, might be more challenged. But that said, I'll show it later that the pandemic provides a good stress case and bodes well for lessor performance. Also, I just note here that lessor exposure is generally moderate to the Middle East airlines, which are the most impacted, with our rated lessors at less than 12% of exposure. So those lessors, it's not really a key concern, given those airlines are well capitalized and government backed as well. I also note some further mitigants for top tier lessors, focus on diverse portfolios, and focus on tier 1 and flag carrier airlines. They maintain moderate leverage levels and have strong liquidity available. They've proven access to funding in past market disruptions. And they tend to focus on young, fuel-efficient aircraft, which could even see increased demand in a high fuel cost environment. We can move to the next slide. So when we think about the risk to lessors from a potential credit weakness, non-payment, or even a decline in flight traffic in sort of a worst case, although not expected, we can look to the pandemic as a stress case. So during COVID, there was a 70% decline in passenger traffic in 2020, with a recovery over a few years. During this time, 60% of airlines received some rental deferrals, and during that time, leases were also signed at lower yields. So a very severe stress, as everyone's aware of, for the industry. Positively for large diversified lessors, with the benefits I was talking about earlier, strong balance sheets, significant liquidity, they were able to provide temporary relief to their customer base and still maintain IG credit metrics. So if we look on the graph to the right, this is showing for Air Lease, Avalon, and DAE, aggregate total revenue, aggregate operating cash flow, and then the average net debt to equity leverage. And you can see these lessors are quite resilient, with revenue declining about 7% in 2020 and operating cash flow declining about 27%, but remaining positive and recovering along with the industry recovery. Also just to caveat that smaller, more concentrated lessors had a bit more challenging time. If they have maturity walls, for example, but the large, sort of well-established lessors have significant staggered maturities and significant liquidity. So overall, when we think about, we don't expect this current crisis to be as stressful as COVID, and the COVID performance of lessors bodes well for their ability to navigate the current environment. So now I'll pass it over to Alan Greenblatt to speak on ABS impacts.
Thanks, Mike. I'm Alan Greenblatt, and I'll cover aviation ABS. Next slide, please. So as Mike mentioned, the lessors have not felt the hit yet, which in turn leads to the aviation ABS deals as well. So over the past 18 months or so, lease income within aviation ABS has been increasing. And even as the recent April payment dates, we also have seen an increase in lease income month over month. So far, there's been no immediate hit to the aviation deals, although it doesn't mean potentially as this goes on, there could be an impact later on. If we look back what happened during COVID, as Mike mentioned, the lessors and the airlines, everyone was requesting payment deferrals. We noticed in the ABS deals, about 60% of those deferrals were granted. In cases where there was not payment deferrals granted, ABS deals, some of them felt over 70% delinquencies. As mentioned, we haven't seen that yet translate into the current aviation ABS deals, but for a point in time of how things got bad in COVID. If you look at how KBRA stresses the aviation ABS deals, for our A-rated bonds, we typically assume, or we stress the transactions at default of lessees are in the range of mid-60s to 70%, which typical aviation ABS deals have an airline credit rating or credit estimate of call within the B category. Next slide, please. So as mentioned, COVID was the low of lows, just for a point to correlate to. The high deferrals that came in 60+%, 70+% delinquencies, majority of Class A notes and Class B notes, which were rated in the A category and triple B category, were falling behind on scheduled principal. If you fast forward to today, 6 years later, that number is down to only 20% of the Class A's are behind on scheduled principal. There were no defaults on any transactions, yet there were several deals that missed scheduled principal. And as mentioned, although 80% of deals were falling behind, majority of them have caught up. On top of transactions that are still outstanding, catching up, we had over 50 deals outstanding at the beginning of COVID, roughly 25 billion of notes issued. Almost half of those transactions have been repaid that were outstanding during COVID and fell behind on scheduled principal, including some in 2026, as well in 2025. We saw about 15 transactions that have been repaid. So if you look at COVID, probably the worst time in aviation history of how where travel fell to and deals falling behind principal. None of the aviation ABS deals defaulted or incurred losses, and almost half of them actually have been repaid, and majority of them are now caught up on scheduled principal. Next slide, please. So there has been some changes to structures. If you look at the waterfalls from 2024 and earlier to transactions now in 2025 and 2026. So as I mentioned, a lot of deals that were outstanding during COVID did miss scheduled principal. The way the waterfalls work, you have Class A interest, then Class B interest, then Class A scheduled principal. So that amounts to a little more than 50% of cash flows needed to come in to fulfill the full amount of A interest, B interest, and A scheduled principal to be paid. As mentioned earlier, we saw 60% payment deferrals, 70% of delinquencies. So clearly, the A's were not able to maintain their scheduled principal, and majority of the B's were not either during COVID. In the past 18 months, the waterfall has changed slightly, where now, as you can see, the Class B interest is subordinate to the Class A scheduled principal. So what that means, which we are not seeing today by any means, but if numbers got to where they were in COVID, you could start to see Class B interest being missed because you would need to fulfill the full Class A scheduled principal. So it is something we are looking out for, but what we have seen so far in cash flows, month over month, we've seen in the most recent April payment dates an increase in lease income. We have not seen or heard from lessors many or if any payment deferrals coming in or any payment deferrals being accepted. And we have not seen in the most recent payment dates any delinquencies that were not previous to the fuel impact in the most recent payment dates. So with that, I will turn it over back to Van, and we will do some Q&A.
Thank you, Alan, and thank you, Boris and Michael as well. All very interesting perspective on sort of the backdrop to all of this and how we assess the uncertainty surrounding the sectors going forward. So, with that in mind, let me kick things off with a question of my own here. What would drive rating actions across airlines, lessors, and aviation ABS if elevated fuel prices and operational disruptions persist? Let's go down the line here one by one. Boris, you want to kick things off?
Sure, absolutely. So from the corporate perspective, we would take a very measured case-by-case approach. So the elevated fuel prices are in themselves do not automatically translate into a negative rating action. We would focus on duration, liquidity, and just overall credit picture for any specific airline. And similarly for aviation transactions, we would check the performance, the cash flow, coverage, and the various structural protections before any rating action takes place. Overall, if this persists and begins to weaken liquidity, then there's potential for a negative rating action. But if the disruption is short-lived, then in our opinion, many issuers and structures can actually absorb it.
Okay, Michael, let's go to you. What would drive rating actions, presumably downgrades here, if we got into an elevated fuel environment that persisted for quite some time?
Mhm. Yeah, so like Boris has covered here, we take long-term views. Ratings reflect long-term views and don't take knee-jerk reactions. So as like I was mentioning, lessors are quite resilient. We expect them to be able to manage their credit metrics without material change. It would take a really significant, hard to imagine scenario to really move credit metrics or deplete liquidity in a way that would cause us to take negative rating action. even in global recessions, we've seen travel demand be resilient. We have seen in the pandemic, we've seen governments have propensity to support their flag carriers because air travel is structurally strategically important to interconnectivity of the world and countries. So we don't expect that to change. So it's hard to come up with a scenario at this point.
Yeah, I think it's great color. Um, Alan, let's go to you. What would cause you to think about a rating action from an ABS standpoint?
Sure. So for some context, in 2020, KBRA downgraded just about every single aviation ABS transaction. Travel hit lows of single digits. We saw deferrals 60+%, 70% delinquencies, cash flows coming in 20% of what they were. So the same way that we do our normal surveillance across the board, we look at lease and maintenance income that comes in every month, month over month. We look at is interest and scheduled principal being paid on the notes. We'll look at if there's any changes to DSCR as well as LTV coverage. See, what we saw during COVID, DSCR all below one. So that would be an initial indicator of something is wrong. And a change that actually happened since COVID, it used to be a trailing 6-month DSCR calculation. In any post-COVID transaction, 2021 and forward, the lessor community and the bankers, they proposed a 3-month number, which would be more reactive if something were to go wrong, and which potentially could cause us to either take watch or downgrade transactions if we saw a huge declining lease and maintenance income, as well as declining DSCR throughout our transactions.
Yep. Okay. I think we've covered that pretty well. All right. Our first audience question. Passenger demand has remained strong, but airline margins are still thin. What matters more for airline credit quality right now, demand growth or cost control? It sounds like one for you, Boris.
Yeah, it sounds like it. So the best way to kind of quantify these dynamics, so demand kind of sets the revenue floor, and then cost control determines how much of that is actually translated into EBITDA, cash flow, and a potential revenue reduction. So in the current environment, obviously, cost control is the more important, unfortunately, credit driver.
Yeah, and I assume there's going to be a limit to how much cost control or how much you can adjust the cost side of things. And so clearly a low cost carrier would be more vulnerable in this environment.
Absolutely. Yeah. And that's what we were watching. Yep.
All right, next question. How should investors think about the difference between near-term stress on airlines versus the impact on lessors? Michael, do you want to take a shot at that one?
Sure. So yeah, the difference with airlines versus lessors. So airlines they have thin margins, could come under pressure. They have direct fuel cost exposure, while on the other side, lessors benefit from long-term contracted revenue, and they own the most in-demand aircraft assets that are in scarce supply. They also have exposure diversity across airlines. So yeah, much more insulated. And generally, lessors have lower leverage and greater funding flexibility. So several differences there. Yeah. Yeah. So pretty much, yeah, lessors expect to be more resilient.
Yeah, I mean, very different business models, obviously, and the vulnerability of cash flows, it sounds like in favor of the lessors. Next question we've got, let's see. Are you seeing any impact yet in aircraft ABS performance? Alan, interesting context, talking about COVID, a true shock. What are you seeing thus far in the ABS market?
So the one thing to keep in mind, so the leases are hell or high water. So the airlines will feel the fuel pressure first immediately, they then have to stop paying their hell or high water lease to the ABS. Yes, they can be delinquent. They could ask for a payment deferral. The lessor would need to then, as mentioned before, have to accept it. So it will take time. You may see declining airlines first, but for it to impact the ABS, it will be a lagged metric. So currently, the April payment date, which is based off of March collections, we have not seen anything yet. So coming up on the 15th, around that for the next payment date, May 15th, we'll see information around April collections, which speaking with lessors, they have not, as Mike mentioned earlier, they have not been granting, if any, requests. So on the ABS side, we have not seen deterioration yet. If we were, you'll first start seeing it in the airlines and then potentially X months later in the ABS.
Okay, got it. Next question here. Could there be supply chain disruptions that decrease aircraft supply and MRO capacity? Boris, you want to take that one?
Sure. So yeah, so the short answer is clearly yes. But the best way to frame this as an existing problem, and what is happening right now could simply magnify it. Since the pandemic, the industry has accumulated rather large aircraft delivery shortfall. The current number is a little bit over 5,000 aircraft or so. The order backlog is well over 17,000 aircraft across both Boeing and Airbus. So if this conflict drags on, we expect just multiplying effect and just creating an additional constraint on an already difficult environment. That's just the unfortunate consequence of what is happening in the Middle East right now.
Yep, you got it. All right, next question. Could a prolonged period of fuel volatility create opportunities for lessors? Mike, what's the perspective there?
Yeah, I think so. Not only sort of some of the mitigants of the dynamics I was mentioning earlier, but also upside opportunities could result. So lessors who, especially those who focus on new technology aircraft, like Airbus Neos or the Max, and those that have order book slots, which are sold out into the next decade. So they could even see higher demand in elevated fuel cost environment as airlines. The one of the best hedges is to operate the most fuel efficient, cost effective aircraft to operate. So those that own the lessors that own those could see higher lease rates and higher demand. So and then on the supply side, as Boris just mentioned, the disruption, if there's any disruption to supply chains and MRO capacity, that tightens supply, which is positive for lease rates and aircraft values. And then, possibly for smaller lessors, if they're looking to grow, we saw during the pandemic there was increased sale leaseback opportunities. So airlines looking for sale leasebacks to free up capital. So there could be some more activity in that space, which creates good buying opportunities at better prices. So yeah, see a few opportunities.
Yep. Another question here. Are certain aircraft ABS structures or exposures more vulnerable in a prolonged fuel stress scenario? Alan, how would you answer that?
Yeah, potentially. So what's going to hit first in an ABS deal? The subordinate tranches. They will start to feel it more or first before the senior tranches. Same thing during COVID. The Class Bs, and if there are any Class Cs in deals, they will miss scheduled principal. And now potentially with how structures and the waterfall has changed, interest. Which transactions may that occur in? I think as Boris mentioned earlier, this is going to impact airlines that were weaker previously, that are more thinly margined and have to endure the increased fuel costs, those are the ones that will feel it first. They'll first have delinquencies in the deal. So if overall the transaction has weaker airlines, those will be the ones that potentially could feel it more. At the same time, though, the structures that may have lesser credit quality airlines, we take that into consideration when we're rating the deal at closing. We work with Boris and team to have a credit estimate on the entire portfolio. We run it through our Monte Carlo and come up with a default assumption. So if the pool was quote unquote weaker at closing, that's taken into account in the structure, and potentially those structures were lower levered than a deal that had a much higher credit quality transaction. But all in all, weaker credits, as Boris mentioned, will feel it first. So if you have weaker credits in a deal, potentially you'll feel it first, as well as in any ABS transaction, the subordinate tranches will get impacted prior to the senior tranches.
Yeah, makes sense. Okay, I think given the time here, let's bring this thing to a close. I think very interesting perspective from three different asset classes across the impact of higher fuel costs to the aviation industry and financing vehicles. I want to thank my panelists, Alan, Boris, and Michael. Maybe Allison, if we can go back to that initial QR slide to allow people to access our work, all available on kbra.com. Maybe that would be helpful. We'll see if we can pull that off. In any event, again, check our website for our latest research around the sectors. Thanks again for tuning in, and let us know what you think. Thank you very much.
Great. Thank you, Ben. Thank you, everyone.